Mr. Ravi, by the way, although on paper this class, not on paper lah, I told you the class is 8:30 until 10, but our practice is to finish by 9:50
Yeah,
to give time for the students to attend their next class at 10 o'clock.
prepare the next one. Yes, yes.
All right. Okay, so I'll pass the screen to you, Mr. Ravi.
Yeah, thanks so much. Welcome, everybody, each and every one of you. A very good morning to all of you. Um, Now, what we have in our agenda is we've got to cover three chapters in our list of topics under the study guide, right? So the study guide has actually been given to you, and if you notice in the study guide, there is a list of topics that is highlighted. So if they go to the list of topics, so if you notice in the list of topics, you have many types. Okay, so you've got almost about 32 chapters altogether, but it's slightly more than that. Now here, what happens is we have actually covered. I think Dr. Salva has already covered a few issues on relating to companies, right? So the corporate tax computation, how to prepare a tax computation for a company, such as a manufacturing company, a trading company, or a services-based company. Okay, so. But included inside here, we've actually got the specialized industries in what we normally call as BISA, B-I-S-A, which is made up of banking, insurance, sea, and air undertakings. Okay, so now these four entities, these four resident businesses, right? These four resident businesses have got a very unique treatment. Okay, this BISA has got a very unique treatment. Okay, and everything, as you know, like we have already discussed, our Income Tax Act, everything is actually based on a legislation, on an act. Okay, so you cannot apply all the rules uniformly. So it actually depends on what industry you're preparing the tax computation for. So if you're preparing a tax computation for an insurance company, it has got some specific rules. Okay, particularly to that industry. Okay, so banks have got certain rules. C undertakings like MISC, for example, undertakings like Malaysian Airlines and AirAsia. Okay, but one of the unique features we have in this BISA compared to, say, a trading company or manufacturing company is, now let us say, for example, you take a shipping company or an airline company, right? So when I take say an airline company, when we are receiving dividend income, right? When I'm receiving dividend income, okay, let's say, for example, they are receiving it from a local company in Malaysia. What is the tax treatment when the airline company receives a dividend from a local company? When an airline company, when a Malaysian resident company is paying dividends to a shareholder, what is the tax treatment for that shareholder? Is it taxable or is it exempt? Now, when I'm asking you a question, I'm going to ask you a big favor. I want you to answer the question, okay? Now, don't worry. Even even I make mistakes. By asking more questions, sometimes you can actually improve. So now I'm asking you a question. When a company, such as an airlines company, is receiving dividend income from a Malaysian company, a local company, what is the tax treatment for the shareholder who's receiving the dividends? Is it taxable or is it exempt?
Exempted.
It is exempted under para 12B of Schedule 6. It is exempted. Okay, but what happens if we are actually receiving dividend income from an overseas company? Is it taxable or is it exempt? Let's say the insurance company or the banks or the shipping company or the airline company is receiving dividend income from an overseas company. Is it taxable or is it? I'm sorry?
Taxable.
It is? It is?
Taxable.
Very good. Taxable. Why? Because para 28, Schedule 6, does not apply, right? It's not applicable, right? So that is one of the unique differences between a normal company and a visa. Okay, so with that in mind, now what I'm going to do is I'm going to go into the shipping and airline company first, and then we go into insurance. The banking one is actually easy. We don't have much time to take for the banking, but I will be taking some time for the shipping, but I'll be taking a little bit extra time for the insurance. Okay, so let me actually start up with the shipping and airline, right? C and A undertakings such as MISC or Genting Cruise, or airline such as Malaysian Airlines, right? Malindo and AirAsia. Okay. Now, for the shipping industry, we've got a special treatment. Okay, there are some exemptions that we're going to discuss only for the shipping. So so let me go through the summarized version of the notes that you have in your study guide. Then we will go through your study guide, and then we will try to do an exam question. Okay, that's what we're going to do for the next 1.5 hours. Okay. Now, for the resident C and A operators, it is normally the rules are covered under Section 54 of the Income Tax Act. Okay, so anyone who is in the business of transporting passengers, right, a cargo by sea and air, right, they are actually assessed on a world income scope. See, that is the point that I was trying to test you on, and you have completely understood it. Okay, so they are actually assessed on a world. In fact, every single business, right, every single businesses, right, way back in before before we got our independence, was actually subject to tax, right? But over the years, when we started from 1967, we decided to change the laws, right? So for world income scopes, now if there's any question, you please either unmute, right? Either unmute, or you write it in a chat box. Okay, if there's any questions at all. Okay. So the more questions it is, the better it is. Okay. Okay. So now, for the world income scope, right? So what we discussed was income wherever accrued or derived is deemed derived from Malaysia. So let's say, for example, AirAsia has got a branch in London, and they make 100,000 in profits. Okay. And of course, obviously, they have to pay UK taxes. They had to pay taxes in the UK, right? But that income that relates to AirAsia's airline operations, right, business, is subject to tax because AirAsia is a resident operator of an airline, right? So any resident airline who is deriving income from outside of Malaysia will be taxed on an accrual basis inside Malaysia. Okay. Now, let's say, for example, they did not remit any portion of the 100,000 profits into Malaysia. For Malaysia, is very simple. You have to pay tax on 100,000. Okay, but don't worry. You will be able to get a credit for the tax suffered in that foreign jurisdiction. Okay, so for the UK taxes that you suffered, we are going to enjoy something called a unilateral or a bilateral relief. Okay, that is something that is very important, where one income is actually taxed in Malaysia, which has suffered tax from in a foreign jurisdiction, then a credit will be available for you to set off against that income. Okay, so in this case, UK Malaysia has got a double taxation agreement, so therefore they can claim a bilateral credit for income tax purposes. So the IRB doesn't want anything extra from you. Okay, they don't want you to pay extra taxes. You just pay what is due to you. That's enough, right? You do your part, fine. Everybody's happy. Okay, so the gross income, adjusted income, and adjusted loss and statutory income is computed in a world income score basis. Okay, so that is different from the manufacturing company that we discussed earlier, or a trading company, or an investment holding company, right? Or an individual like you, right? So even you can enjoy foreign source income exemption, but these four entities that we discussed, the so-called visa, will not be able to enjoy it. Okay. Now the foreign income is assessed to Malaysian tax whether the income is received or not. So if the business income of AirAsia is not remitted into Malaysia, sorry, it relates to your business income, it will be taxed on an accrual basis, right? But if there is any investment income, let's say, for example, AirAsia has got an investment in a hotel in Melbourne, right? So they've got a hotel, they own a hotel tower and they're renting it out, for example. Now, that rental income will only be subject to tax in Malaysia when it is received. Okay, So let's say, for example, MISC has actually got a subsidiary in Vietnam, right? So when they invest in Vietnam, they'll be getting dividend income, right? So when the shipping company receives dividend income in Malaysia, it is taxed only upon receipt, okay? So we have this treatment for investment income only taxed upon receipt, according to Section 3, and business income will be taxed on an accrual basis, okay? Okay, so now, business of transporting passengers or cargo by land or other businesses or investment activities, and the scope is on a modified. That means business income on a accrual basis, and non-business income will be taxed when it's received. Okay. Now I'm going to move away from. Now we're not talking about people like Lufthansa. We're not talking about foreign shipping companies or airline companies. They are known as non-residents. So non-residents have got a very special treatment on the taxes on their income. Okay. So non-resident companies will be taxed differently, right, compared to resident companies. Okay. So now we'll focus on resident companies. Okay. Now I'm going to zoom in. I'm just going to zoom in, only talking about shipping companies now. Okay. I'm not talking about airline companies. Okay. Now, for airline companies, there are specific incentives given to us under the approved services project, which you'll be covering under incentives. Okay, but we're not discussing anything about airlines now. We're just focusing on shipping companies, resident shipping companies. Okay, so that Section 654A is now giving us an exemption for a resident seagoing or shipping operator, right? Shipping company like MISC or Genting Cruise. Okay. Now, the income derived from Malaysian ships. So there are certain conditions. Okay. So in order to make this, in order to enjoy this exemption, there are certain conditions. And what is the exemption, ladies and gents? 100% of your statutory income from exempt ships, right? Right from your statutory income will not be subject to tax. Right? So if you have certain Malaysian ships, and if you have a statutory income, 100% of that SI, like SI is 100,000, 100% of SI is tax exempt. Okay? So these shipping companies are enjoying a very generous incentive. Okay? But if they have any non-shipping income or non-exempt income, that will be subject to tax under normal, under 24%. Okay, they'll have to pay tax at the chargeable income the rate 24%. Okay, so let's look at some details. It has to be a Malaysian ship. So there is one requirement for it to be Malaysian ship. So there has to be a definition of Malaysian ships. Okay. Now, number two is you have to be resident. So resident person carrying on a business of either transporting passengers, right? Your Genting Cruise, your MISC is having a passenger a cruise, or a cargo by sea, right? Now, this ship must be able to go to the seas. It cannot be going from Port Klang to Penang, right? Now, that, let's say you're taking a ferry, it can go from Butterworth to Penang, but I don't think so it'll make it in the sea, right? So ferries are not included. Right, so any type of say ships that is like a ferry cannot enjoy this exemption, right? So it must be a sea-going ship. It must be able to go from Port Klang to Poland, to South Africa, to Japan, to China, right, to Indonesia, right? It must be sea-going, okay? And on board Malaysian ships. But let's say, for example, now I'm actually owning the ship, right? I own the ship. Say, let's say I actually spend about 50 million to have one ship, and I rent it out. Okay? So I'm in the business of renting out, or what we call letting out on charter a Malaysian ship. Letting out on charter a Malaysian ship owned by him on a voyage charter basis. Okay, so let's say somebody comes to you and says, look, I want to go from Port Klang to Melbourne. How much? Okay. So we tell them, yeah, normally it's 1 million. Okay. That income from letting out on charter a Malaysian ship is tax exempted also. Okay, so for the owner of the ship, I can get an exemption on that 1 million. Okay, but then let's say another customer comes here and says, look, I want to go on 1st of January 2021 till 30th June 2021. How much? So we tell them, okay, it is 5 million. That 5 million is also exempted. Okay, it is also able to enjoy the exemption. Okay, so you are in the business of transporting passengers or cargo by sea on board Malaysian ships, or renting out, or what we call letting out on charter a Malaysian ship on two bases, i.e. a voyage or a time charter basis. Okay. Now, here I've got a summary of the information here, but everything is in your book. Not to worry. Okay, everything's in your book. Okay. Now, you have to be resident. Fine, that's good. Carrying on business of transporting passengers or cargo or letting out on voyage or charter, we have an idea. But ladies and gents, there is a definition for Malaysian ships. It excludes ferries, barge, tugboat, right? Supply vessels, right? Let's say, for example, now you're actually operating an oil rig, right, in Terengganu, right, or Sarawak, and you're taking from the coast, right, to the oil rig. You take the supply vessel, you take the food, you take the supply people, right, the personnel. That is not a seagoing. That's not a Malaysian ship, right? A crew boat, right, lighter dredgers, fishing boats are the similar. So they cannot enjoy exemptions. So if a shipping company has a ferry, then you actually determine the statutory income normal, and then you pay taxes based on the chargeable income at the rate of 24%. Okay, because normally shipping companies, they are heavily capitalized, right? You know who's involved between in shipping companies in Malaysia. Petronas is actually heavily involved, right? So these are what we call giants, right? They are all gigantic. Oil and gases, they are all giants, right? So they don't actually deal with this. So there's no SME here for applicable. It's normally a 24% rate for shipping companies, okay? Including even airline companies, okay? Now, the rental income from leasing on voyage or time charter will be exempted, provided the taxpayer is legal owner. Now, the Malaysian ship means it's seagoing and is registered under the MSO Act. Let me just write that here. Act of 1952. It's actually quite an old act, right? So as long as the Malaysian ship is registered in the MSO, why not, right? Your ship is seagoing and ocean going, right? Registered MSO. You have a place of business in Malaysia. Yes, we have a majority of shareholdings, right? At least 3/5 of the total directs are Malaysians, right? And we go, and these ships, let's say, for example, we have 3 ships, Chris 1, Chris 2, Chris 3, right? They qualify for exemptions under 54A. You can combine all the adjusted income, you can combine all the cap allowances and have one lump sum treatment, right? So you can actually combine all Malaysian ships together, right? Although we're actually assessing it on a ship by ship basis, but for exempt ships, you are having a separate treatment whereby you will be taxed, right, by combining all the income. But don't forget, if you have losses also, you have to take that into account, okay? Don't forget the losses, okay? So if you have any unabsorbed losses and capital allowances, you cannot take it and minus against your, or deduct it against your taxable shipping income, okay? That because here you're having a unique treatment where you're exempted from Malaysian ships, so you cannot take this income and minus it, okay? And the tax exempt dividends is after adjusted loss can be distributed. So that exempt income, that is high 100%, can be taken into your dividend, tax exempt dividend income and be paid to your shareholders on a 2-tier dividend distribution basis. Okay. So now, ladies and gents, what we'll do is, now, ladies and gents, may I ask you, is there any questions so far?
Hello, Mr. Ravi.
Yes, please.
I'm Sakina. I have a question.
Yes, Sakina.
Would a ship from Port Klang that goes to like Miri, for example, would it be considered as seagoing?
Miri, no. Right? See, what we're expecting is a seagoing ship is a ship that is able to go into the sea, right? So if you're using a ship, the shipping operations, you see, let's say, for example, now, let's say you're operating, you're MIC, right? Now, if you're going to take a ship to go to, say, to Miri, if you're going to take a ship, now that one is going to be very, very, very expensive. It may not, the cost of actually freight, the shipping charges, right? The cost, let's say, for example, you're shipping my goods, right? So it'll be most economical for the shipping operator to send it in a ship that meets its requirements. So if I can send it through a barge, right? So let's say, for example, now they're charging me 5,000. Okay. So now to send it in a barge is 5,000. But if I'm going to now send it in a ship, seagoing ship, they're going to charge you 15,000. Then I'll tell them, sorry, I can't come to you. Thank you very much. And then you go on to look for somebody else who can meet my needs. Okay. So generally speaking, if it is within a certain period, like a certain areas, right? Like even sending it to Singapore, also you don't need to have a seagoing ship to send it. If I can actually send it in through a barge, a barge is this huge vehicle that this ship that carrier that actually takes a lot of goods, like petroleum, for example, or crude palm oil, right? So I just send it through a barge, pop, and within a much lesser cost, I can finish it. So normally seagoing ships, like if you want to go to China, if you want to go to Poland, you want to go to South Africa, you have to use a seagoing ship, because you try to use a barge, it won't reach. Okay, so generally speaking, when you're talking about something where it's close proximity, I will try to use, can I use a supply vessel? Oh, supply vessel too risky because Miri is quite far. So then I try to use it. So normally they are not actually used, right? For seagoing ships, we don't normally use it for carrying goods to close destinations if it can be done through an alternative method. Okay, so that's why you see it's a good question. You see that's why it's actually much cheaper. You see, let's say for example now there's somebody coming from let's say there's a Chinese shipping vessel or a Japanese shipping vessel that is coming in from, say, they're coming in from Indonesia. Okay, so let's say for example they're coming to Port Klang, right? And let's say this Japanese shipping company is going to go to Miri, right? You see, it is much cheaper. It's sometimes, you see the mechanics for this freight forwarding business in Malaysia is very unique. It is much cheaper. It is much cheaper to send it through that vehicle than taking it through ours, because they have tons. They have tons and tons and many ships operating. So they go to Miri, they go to Sarawak, they go to Labuan, and they go back to Japan. And they go to China's and Hong Kong's and all that. So it is actually highly comparative. So the rates are very, very, very much lower. Okay. So we constantly do this. You see, this question you asked is so important, because you see, if I'm going to ship something and it's going to be very expensive for me, then my profits are going to go down. Right? My profits in everything today, what is happening outside. Profits, cash. Can I make money or not? Right? Can I ship? And am I allowed to go to Port Klang in the first place? They're asking me for a permit. The world is actually very different now. But now, referring to the question whether seagoing and ships or not, if it is meeting the criteria that we're going to discuss, then you get an exemption, right? But normally we don't use, right? If it is actually something that we can actually settle through a supply vessel, then, or a barge, right? So then that's when it won't qualify. Okay, but otherwise, a seagoing ship is like what we discussed earlier. Okay, so now we will go to, say, section your chapter 6. Okay, chapter 6 deals with air operators like IAG and Malaysian Airlines. All right, air transport and sea transport businesses. Okay, and we normally call them as specialized industries. These 4 BSAs, right? They make, of course, BSAs make a lot of money, right? They make tons of money. Like banks, for example, they make tons of money. Insurance companies make a ton, right? But airlines, unfortunately, because of the current situation, they make a lot of money. They do make a lot of money, but unfortunately, their industry is actually heavily hit. In fact, one of the worst hit industries at the moment is actually the airline industry, right? Tourism is badly hit. So otherwise, they make some decent amount of profits, right? They make decent amount of profits. So sea operators, now they are actually they are dealt with. Now let's say, for example, MIC has got land transport, They don't only have ships, they have lands. So the land is actually treated separately. Okay, you don't have any special treatment for land, your lorries. Okay, we are talking about only ships. Okay, so they are dealt with in section 54, and then there's another 54A for shipping. Shipping. So the transport business, such as lorry, transport, buses, taxis, and all that, they are actually subject to tax under normal, right? Section 4A, business income, right? So they are not. Okay, and we will talk about non-resident companies, where there are two methods. Right, it's quite interesting the way they're taxed, and it's much easier to understand. But let me finish up with the basis of taxation. Okay. So the airline, right, and the shipping industries, right. So rules on determining the assessable profits for a resident, right, is different from a non-resident. Residence is taxed on the world income score. But non-resident is only taxed on the income derived from Malaysia. Okay, so let's say, for example, British Airways comes from Heathrow, picks up say 200,000 worth of passengers and comes into KLIA, right? They drop the passengers, and then they pick another 180,000 from KLIA to go to Hong Kong. British Airways, the non-resident operator, will be taxed only on the income that is derived from Malaysia, which is 180,000. Okay, the Malaysian government does not want anything that is derived from outside of Malaysia. They have no rights to actually tax income that is derived for the non-resident outside of Malaysia. The only rights they have is for the income derived from Malaysia. So the 180,000, you have to pay income tax in Malaysia. Okay, so we'll come to non-residents later. Okay, so where you have transporting by passenger, by cargo, by sea or air, right, is different from other activities. So if you have, say, two exempt ships, CRIS 1 and CRIS 2, and you have a barge, right, you have to separate. You have to do the tax computation separately. Okay, you cannot combine. Okay, because IRB is worried that you might pay less taxes. Okay, and we need to be careful about self-assessment. Okay, let's look at this one definitions. Okay, Malaysian ship. Very good. So now, when you're reading this, you'll be able to understand it. Okay, so one of the reasons why we don't go into the study guide immediately is because it's got too many words. Okay, so when you see something, being accountants, we like to see less words, more figures. So now when you read this Malaysian ship, it's suggesting that it's a seagoing ship, registered in the MSO 1952, and excludes ferries, barges, right, tugboats, right, crew boats, right. And here, ladies and gents, once you're registered in MSO, for insurance purposes, you're highly, highly regulated. You have to maintain cost, right? You have to give a record of what maintenance did you do? You changed this part. What is the name of this part, right? Who changed this part? Who took this part and placed it and changed this in that ship? It is highly, highly regulated. Why, ladies and gents? Because of the insurance, right? The insurance company, right? The shipping industry regulators also want to make sure that you are meeting all the requirements. Just like an airline. Airline is extremely, extremely regulated, right? They're carrying things, very precious things in the air, right? So therefore, when you are now going to register for a Malaysian ship, you have to go into it's a very interesting territory. Okay. Now I'll come to this casual calls when I'm dealing with non-residents. I'll come back to this later because it actually deals with non-residents, but we'll come back to the casual calls later. Okay. Now, as far as person is concerned, a partnership is also regarded as a person. For income tax purposes, as you know, partnerships are actually not subject to taxes. They have to just do some reporting, but the income from the partnership is assessed in the individual partners. Okay, so the partnership doesn't. All they have to do is report, saying that there's two partners, A and B. They got so much of income, and A and B will go and file their returns and say that. But for shipping businesses, right? So, and airlines, a partnership deriving income from shipping and transport is a legal entity subject to tax. Okay. So now we go into resident operators and charterers. Okay, so you're actually operating in the business of transporting passengers and cargo by sea or by chartering, right? By chartering. Okay, and they go on a world income basis. Okay, so you look at this shipping company, SS Berhad, resident company in Malaysia has been operating non-Malaysian registered ships, right? Non-Malaysian, huh? Non-Malaysian. So Malaysian, remember Malaysian ships and non-Malaysian. Okay. So non-Malaysian ships for the last 2 years, and details the shipping operations for the financial year 31st December 2019 as follows. So the adjusted income is 5.5, and of course their cost of ships is very expensive, right? Normally they actually leased, right? Just like airlines, but sometimes they actually own it, right? MIC has actually got a fleet, right? A fleet of ships. It's a big industry. It's a multi-billion-dollar industry. Okay. So what is stat income? So stat income, you take your adjusted income, claim your annual allowance rates of 20%, and therefore you have an excess here. All right. That excess you can carry forward, but you can utilize 5.5 and carry forward the 4.5 million. Okay. Now let's say, for example, we have this TM Airlines, right? Team Malaysia Airlines has been in operation for many years. It's a resident, so it's assessed on a world income scope. Okay. So details of the operations as follows: the adjusted income, the cap allowances, and they have some brought forward. No problem. Just take your adjusted income, claim your brought forwards, claim your current year, and your statutory income from air transport business is 5.1 million. Okay, but it's subject to tax, huh? And you can claim your donations, right? Your donations up to the restricted amount of 10%, right? Your zakats, accounts, right, at 2.5%. All those normal rules apply. Okay. But now, ladies and gents, we shall go to exempt ships. Okay, exempt ships. Okay, here under 54A, right? If you are undertaking two types of businesses, one is transporting passengers by cargo by sea on a Malaysian ship, or letting out on charter on a voyage or time. Okay, time basis. Okay. Now, 100% of the statutory income, ladies and gentlemen, 100%. Okay, 100%. Okay. Now, let us say, for example, the shipping company elects not to claim cap allowances. Okay. The statutory income is determined how, ladies and gents? You take your adjusted income and less your cap allowances, right? That's adjusted income. Okay. So that's adjusted income. Here, if the shipping company does not want to claim cap allowances, okay, the shipping company does not want to claim cap allowances, right? Now they've amended the law from 2009 onwards to say that it is deemed to be claimed. Now, what's the meaning of deemed? Now, this word deemed is one of the most powerful words in the Income Tax Act. This word deemed, okay, like today is supposed to be Wednesday. But the Income Tax Act says, oh, today is deemed to be Sunday. It is something that is not. Okay, so this power, if you see this word called deeming, means it's so powerful, right? Like, say, for example, now, let's say a shipping operator, like, look at this sentence, huh? A ship operator may choose not to claim CAs. So let's say, for example, now, I've got an adjusted income of, say, 1.2 million. Okay, and my cap allowances is 200,000, right? And my statutory income is, say, 1 million. So 1.2 minus 200,000 is 1 million. But the shipping operator is now asking, hey, I don't want to claim cap allowances, can or not? Let me check the act. Yeah, no need. If you want, only you choose. If you don't tap on, no need. In this case, okay, I don't want to claim. Here, kosong. And that case will be 1.2 minus kosong is 1.2 million. Ladies and gents, our IRB was trying to figure out what's happening. Why didn't you claim 200,000? No. The act says if I want to choose, if I want to claim, only claim, otherwise stop or no need. Ladies and gents, from 2009, they decided that cap allowances on the ships are deemed to be claimed, even if you don't want to claim it. Therefore, now, if it is 1.2 million, if your CA that you did not claim for tax purposes, what we will do is we will take the 200,000, minus it, and then the statutory income is now only 1 million. Now, is that understood? Is there any questions so far? Very good, very good. That's nice. Okay. Okay. Now, for under 54, right? Remember, 54 is special. The operators or charters of Malaysian ship are not airlines, right? Not airlines anymore. We are talking only about ships. Are required to maintain a separate account for the income derived from each Malaysian ship. Okay. Okay. And capital allowances is now deemed to be claimed. Okay, we saw that. Okay. Now, this exempt income, right? This exempt income is to be maintained. So this like let's say, for example, is Genting Cruise. Let's say 1 million is exempted. They can pay to the shareholders 1 million in cash, right? As long as their profits, they can pay it as dividends, and when the shareholders receive it, is tax exempt, right? So when a corporate shareholder is actually receiving it, they can also further distribute it to their shareholders. Okay, so it's something that was very important, ladies and gents, during the imputation system. Okay, but now we have moved to the single tier system now, right? From 1st January 2014 onwards, single tier. So now it is not that significant. But this exempt income was very significant for shareholders, right? During the imputation system. But now under the single tier system, all you need is profits, right? And then you can pay your dividends. Okay. Now, ladies and gents, before we go into an exam question, okay, I just want to finish up with this public ruling. Okay. Now, the IRB is actually issued, as mentioned, there's one public ruling. So this public ruling, as you know, is actually talking about the IRB's, the DG, Director General's Inland Revenue's interpretation of the law. Okay, so technically speaking, it is not the law, but it is a very good guide for taxpayers and tax practitioners, right, and taxpayers to get an idea what are the rules relating to ships, what I cannot claim, what I cannot claim. Okay, so now, ladies and gents, if you notice in the public ruling, they say 100% SI is exempted. From what operations? Operations from Malaysian ships. If you meet all those conditions, resident, right, transporting passengers or cargo by sea, what are the conditions? Malaysian ship, registered under MSO 1952. Remember all those conditions you meet? 100%. Okay. Then what they do is they actually refer to example 11, ladies and gents. Okay. They refer to example 11. So now what I'm going to do is I'm going to go to, and I want to show you something. Okay, I'll show you something. Okay. Now, this IRB website is something that is very useful, right? It'll be very useful for you when you're doing your studies, right? To get an additional idea. Okay, right? So let's say, for example, now in this case, I've got a public ruling. What's it called? 10/2012. So I go to year 2012. I go to 2012, 10. See this? Tax treatment of Malaysian ships, no problem, thank you. I can go down here. And I go to example 11. Okay, so since it's mentioned in the study guide, okay, fine. So let me, right? So these guidelines will actually give us basically, giving you additional information on what we discussed. What is Malaysian ship, right? What are the type of Malaysian ships you can? What is definition of Malaysian ship? It excludes ferry. All that we discussed, seagoing, right? And then they tell you what can and cannot. Okay, but let us go to example 11. Okay, let us go to example 11. Okay. So example 11 is like this. Okay, look at this. Okay. So M. Sindiam Bahar, a company resident in Malaysia with a paid up of more than 2.5, carry on the business of transporting cargo, right? Cargo, right? LNG, right? LNG, right? Is cargo between Malaysia and Europe. And these ships are registered in the MSO 1952. And they give you some details of their income statement, right? So the gross income from their shipping is 120 million. And then they've got some interest income. They've got some non-business income, right? Interest income, okay? Then they give you some expenditure like salaries, right? You may be having some double deductions, whatever is given to you. And then they have some depreciation, okay? And they give you net profits and they tell you CA is 800,000 and compute the tax computation. Okay? Since they are actually having a 4A source, right? they're having a business source. So what we will do is we'll take the PBT of 43.6 million, and I'm going to make certain adjustments. Okay. So if there's any non-business income, such as your 600,000, you less. And if there's any depreciation, then you add back. Arrive at the adjusted income. And let's say, for example, in the question, they tell you the company decided not to claim cap allowances. They did not claim cap allowances. When they submit a tax return, they didn't claim. They don't want to claim. But what is a deeming provision, ladies and gents? For tax purposes, you have to go and minus, whether you like or not. The deeming provision says, I don't care what you did, you must minus. So 48 minus 800,000, ladies and gents, 100% of SI is tax exempted and transferred to your tax exempt account. Okay. Now, if you have any brought forward losses from shipping exempt ships, you must minus here before you transfer to your tax exempt account. Okay. So basically, the losses has to be utilized against Malaysian ships. You must utilize it to reduce. Okay. But the interest income that you have here, you will not enjoy any exemptions. Okay. So you assess it under 4 small c, right? 4 small c as a separate income, separate source under investments, and then 600 times 24% for your exams, 24, not 25. So then you prepare the tax, right? And you will get the question done, right? So it's 100% of SI, right? It's 100% of SI. Okay, so now I'm going to ask you a question. Is there any questions?
Mr. Ravi,
Yes, please.
I noted that in arriving to your statutory income, you have
Yes,
deducted losses brought forward. It's in your notes just now.
Yeah, if I have losses. Okay, if they say
One thing deducted in arriving to SI and not after SI.
Yeah, you see, for the exempted income, you don't have to pay taxes. So if the losses arise from exempted income, then what you do is you minus it and then transfer the balance to your exempt income.
Oh, I see. So we have means that the logic is that they're trying to minimize your SI so that the lower amount goes into your exempt account.
Yeah, of course, yes. Because otherwise, as you know, the government is actually sacrificing a lot.
Yeah.
See, for the shipping industries, you see, how can you get on? Why can't you give us at least something?
So that is a specific regulations or specific act that says about the losses to be used first.
Yes, and we are going to deal with it now shortly.
All right, thank you.
We're going to deal with it, okay? Because, right? The only thing I need to watch out is the time.
All right, thank you.
So that's the only problem I have. But otherwise, it is but let us do it, okay? But let me just do an exam question first, and then we can get that out of the way. And then once we get a flavor of it, that'll be much easier, okay? Just give me 1 minute. Okay. So let us go, ladies and gents, let us go to okay, now I'm going to go to this 2018 T3 main. Okay, so how I'll describe it is 2018 term 3 main. Okay, main. Okay, and I'll go to question number 3. Question number 3. Okay, I go to question number 3. B. Okay, I understand you have access to this 2018. I understand you have access. Okay. So now, ladies and gents, I'm going to give you, now let us say, for example, now in the exam question, ladies and gents, in the exams, right now, each one mark is 2 minutes. So if the question has 10 marks, you will have 20 minutes, but you must minus it by 10%. So let's say, for example, you have 18 minutes to do the question. So let's say if it's 3 marks in the exam question, not here, in the exam questions, in the exams, 3 marks is maximum 6 minutes, but you got to reduce it by 10%. Okay, so you'll reduce it to say maybe 4 minutes. Okay, now, ladies and gents, now based on what I discussed, okay, right, I'm going to give you 5 minutes to make one attempt on this question. Okay, now you don't worry about whether you can do it and say, let me just give it a shot. Okay, so I'm going to give you 5 minutes to do this, right? And I want to tell me what's the tax payable, right? And I just want you to give it a shot. And once again, the answer, you just unmute and speak and tell me what's the answer, okay? But don't write in full forms, okay? You write in short form, PBT, right? Interest, INT, INC. Don't write in full forms, okay? In the exams, you write full forms, but here you don't write full forms, okay? Okay, so now, ladies and gents, right? So what you did was you took your 79.7 PBT, then you added, right? Remember the added and less. So you added this one non-deductible item called depreciation, right? And then you reduce this 50, right? Reduce and you arrive at your SI, right? And then, ladies and gents, do I claim the CA or you don't claim the CAs in your tax computation? The answer is you deem to claim it. So you must. Sorry, the deeming provision is so powerful that you have no choice. You have to claim. So that also you must minus, and that 100% of that SI from the Malaysian ships, because it is certified, right? It's a Malaysian seagoing, right? Carrying cargo, right? And registered MSO. Therefore, it is 100%. Okay. Now, can anybody tell me what's the tax payable? Never mind. Okay.
$19,125.6.
Now, how do you get 1912? Is it 19,000? I think.
Again, sorry.
You said 19,000.
Yeah.
How do you get 19?
Add back your minus the interest income, because that is separate income.
Yeah.
Then plus depreciation, you have to adjust the income.
Yes, please.
And then minus capital allowance. Then I have my statutory income. Capital allowance claim is 60,000.
Yeah. How much is the SI exempt?
79640.
Yeah. And what is the tax?
Tax at 24% plus 50. The interest income.
Question: what is the tax payable on the tax payable for this company?
19,156.
Tax payable will be on the interest income only.
Oh, yeah, oh, yeah lah.
100% that's it.
Oh, then the taxpayer is going to be very upset with you, Alexa.
Yeah, very upset lah.
Alexa, MD is going to call you. Come on, I'll see you for a meeting. Why are you asking me to pay so much tax?
Exempted. That means that you only tax on the 50,000 interest income.
You just say, okay. But ladies and gents, if I were to ask you the question, whether you've seen this question before, right? Your answer is probably, yeah, I think I've seen this before. In fact, it actually looks exactly like this. See, look at this.
Yeah.
Now you see in the public rulings. Okay, so here when I go back to this, he's referred to example 11, so example 12, for example, right? Example 13, and then he's also referred to how to calculate capital allowances, and also referring to losses. Okay, so let's say for example, yeah. So I mean, let's say for example we go to another situation. Okay, let's say I have this. Okay, let's say I have this piece in Bahad, right? Operating relationships, registered, right? MSO. Let's say it's exempt. So these are exempt ships, exempt and non-exempt. Okay, but the non-exempt, sorry, you had to pay tax, because the IRB will not allow you. Okay, so you take the Malaysians, you add all this together, you combine all the exempt ships together, 150 plus 70, you combine your CA for each ship for C1, C2, C3 pun sama, combine. Okay, and 100%, ladies and gents, is 100% is 100% tax exempt. But sorry, for the barge, 14 minus 2.7, this 11.3 chargeable income, you have to pay tax credit at 24%. Okay, because you are not a SME. Okay. Now let's look at an example where it involves losses, right? Losses. Okay. Losses. Okay, so if I take this example say 16, if I here, look at this. You see, look at this. See, look at this, losses. Okay, so I've got first year AI, so 3.5. You don't minus this, huh? If you have an adjusted loss, it means your adjusted income is kosong, is nil. Okay, we don't have a negative income in Malaysia. We don't recognize negative, right? It's either 0 or positive. It's not negative. Okay, so your adjusted income is 0 here. So 3.5 plus 0 plus 0, you combine, and then this 3 you can combine, no problem, because it's exempt. D, right? This D1, D2, 3 is exempt. So you go and combine and minus. But these two losses, ladies and gentlemen, 800,000, you must utilize here. Okay? Now let us say it was 300,000 here, not 2.3, it was 300,000. Then this, you only utilize out of the 800, 300, and then your SI is kosong. And then you carry forward the balance 500,000 and claim against, right? Before you transfer your tax exempt account, you must minus the 500,000 brought forward losses also. Okay. Okay. So let's say, for example, in this case, right? Let's say, for example, I have 1.3 million. I have a CA of 600,000, and I have a current year loss of 900,000. You see? Then it's excess. So my SI is kosong. So I carry forward the balance of 300,000. Okay. So I go to the next year. Right? And I minus the 300,000, you see? So the IRB will want to make sure that you claim your losses before you transfer to your tax exempt account. Okay? And if you have any lorry transport, any barge transport, whatever transport, that you have to pay normal taxes. Ladies and gents? Okay? Now, before I move away from this topic, I want to just finish up with this. Ladies and gents, one fine day, the Malaysian government actually came up and said, sorry, minta maaf, from 2012 onwards, we're going to give you only 70% exemption. You had to pay tax on 30%. So the shipping industry said, sorry, Minister, can you please tell me what exactly, what did you say just now? No, from 2012 onwards, no more 100%. We'll only give you how many percent? We'll give you only 70% exemptions. That means you want us to pay tax. Yes, we want you because you're making good money, so we want something extra from you. You have already been enjoying this 100% too much, so sorry, we're already sorry, but this is the government policy. Ladies and gents, the industry, our shipping industry is so powerful, they said, sorry, Minister. Minta maaf, sir, Minister. With due respect to you, sir, we are not ready to accept 70%. We want to maintain the 100%. When we are ready, we will let you know. Ladies and gents, the Malaysian government could not enforce the 70%. Okay? They could not. They said, okay, I will give you extension of time. Okay. So first they said, we'll give you until We'll give you an extension of for 2 years. So you look at page 6-8, they said, we will give you the exemption only for these 100% only for 2 years. Okay? It's deferred, postponed. Ladies and gents, eventually it is now postponed until 2020. Okay? So for your examinations, it is not 70%, it is 100%. Okay? So there were some students, what they did was, during the exams, they went and referred to this part, and then they went and took 70%. Okay? And then they could not get the full answer correct. Okay? They couldn't get the answer correct. Okay? Okay. Now, ladies and gents, may I ask you, is there any questions?
So if I were to invest in for shares, for example, in company, so shipping company is one of the possible option because they don't pay tax. So your exempt account is high, so they will pay more dividend, isn't it?
As long as they can make income. I mean, of course, you see now at the moment the pandemic is the value chain is disrupted, but they are in demand. Hey, can you take my goods to Australia or not? Can or not? If you can, if your answer is yes, my God, you look at the opportunities.
Yeah.
No, but last time you charged me 10,000, now you charge me 12,000. Incheck, do you want yes or no? Do you want me to send it? Okay, 12,000, no choice.
Yeah.
Look at this. I mean, it's really, really amazing situation. It's so sad. It's really sad. I mean, we are going to suffer an increased cost, right? Okay, now, ladies and gentlemen, let me quickly, because I've got to finish at 9:50. I've got to maybe a little bit of 9:55, right? So I might just finish 9:50, so you can manage with that 5 minutes. Okay, now let me just quickly wrap up with this non-resident, right? Non-resident. Now, non-residents are different, okay? Non-resident shipping operator or an airline operator, for you, the rules are not the same as what we discussed. Whatever you make in Malaysia, you pay taxes, okay? So let's say, for example, we take the first method. There are two methods for non-resident shipping operators or even airline operators like British Airways, right? And OCLs. Now, we have the 5% method, okay? So let's say, for example, now your gross income from your freight earnings from Malaysia is, say, 10 million, right? So that 5%, ladies and gents, is known as the deemed statutory income. It's called DSI. Let me just write it here, okay? DSI. It's not chargeable income. It's not anything else, huh? It's called DSI. Okay, it's called DSI. And all you have to do is, you don't have to take your calculator. What you do is, you take 10% of 10 million. 10% of 10 million is 1 million. So it's not 10%, it's half of it. So it's 500,000. Okay? It's 500,000. Okay? You can claim any approved donations made to Malaysian approved charitable organizations restricted to 10%. No problem. You can claim, arrive at a chargeable income, and your tax, ladies and gents, will be at 24% because non-resident company rates is 24%. Okay? So under the 5% method, ladies and gents, okay? Under the 5% method, determine the DSI, and multiply against 5%. Right? And then, okay. Now, the other method, ladies and gents, is called the ratio certificate, or sometimes some people call it an acceptable ratio certificate, but it's normally called a ratio certificate method. Okay, ratio certificate method. Now, let's say, now you have to submit your tax returns based on 5% method because they're actually conducting business in Malaysia. So they will be submitting tax returns and they will prepare the tax computation based on the 5% method. Okay, but the non-resident operator, right, the airline or the shipping operator has an option to change their chargeable income and tax based on the acceptable certificate method. Now, this acceptable certificate method will show you certain details such as your world gross earnings. Let's say, for example, somebody is coming from Italy, right, or Norway. Let's say Japan, right? Japanese non-resident operator. So the Japanese tax authorities will issue a certificate saying that the Japanese non-resident company, right, world income is so much. The world adjusted income is so much. And the world cap allowance is so much. So what we do is we take a proportion based on the Malaysian gross divided by the world gross times the world adjusted income, and then arrive at the Malaysian adjusted income. Okay. So if they give you the world adjusted income, what you do is you take the Malaysian related gross income divided by the world gross income and take a proportion to arrive at the Malaysian gross income. Same for CAs. Okay, same for CAs. Okay. But ladies and gents, there are two deductions here. Okay. There are two deductions here, which I'll have to explain to you, and then we can finish out with this topic. Okay. But the conditions to claim for this ratio certificate method is the certificate must be issued by the revenue authorities of the residence of the operator. So if you're coming from, say, Japan, then the Japanese tax authorities will have to issue a certificate. The RB will not accept that the Japanese companies, they will only accept the Japanese tax authorities showing the details. Okay. So the revenue authority must compute an SL full tax. So the whole income is subject to tax in that jurisdiction, right, in Japan. The basis also cannot be very different from us. Like, for example, depreciation in Malaysia, we add back. They also should have similar rules, right? Not exactly same, but similar rules. Okay, nothing very far out. And the certificate must state the gross paid earnings, the gross profits, and the gross what we call capital allowances, right? And we take, right, and then we take 24% of the tax. Okay. But ladies and gents, now I want to explain two things to you. Okay. Now, in the acceptable ratio certificate, let's say, for example, now the Malaysian gross income is 10 million, but it includes a transshipment and includes a casual call. So here now I'm going to explain casual call to you and transshipment. Okay, but let me finish up with transshipment first. Now, let's say somebody from Heathrow wants to send something to Indonesia. Okay, so they give it to British Airways and say, hey, son, can you do me a favor? Can you just take it to KLIA? You just transit it, right? It's basically what we call another word for transit, right? But you can't ship it, right? So you give it to the Garuda guys over there, and then then Garuda will actually pick it up and go to Jakarta, and everything's fine. Okay. So once it lands from, say, one ship to another aircraft, or from an aircraft to another aircraft, right, or an aircraft to a ship, that transshipment, ladies and gents, you must less. Okay. So if you have a question that involves under the ratio certificate method saying that there's a 10 million, but there's a 1 million from transshipment, that means the amount of income will be subject to tax is only 9 million. Okay. And I'll show that to you shortly in your book. Okay. Next one is called casual calls. That's the one I promised you that I will do. So now I want to go back to that page because I promised you that I will come back to this page. Okay. So this, ladies and gents, is known as a casual call. Okay. Now, let's say, for example, somebody is going from South Africa to Melbourne. Okay. They're coming through the straits, but suddenly there is an emergency in their ship, and they call Port Klang and say, sorry, sir, can we come and drop into your port? We have a problem. Can you help us? So Port Klang, of course, is very happy. They come in, and then let's say, for example, let's say I was there, right? So I asked the South African shipping operator and say, hey, where are you going, man? So I tell them, hey, I want to ship something to Melbourne. Yeah, are you going there? Yeah, we're going there. No problem. So when I give him that, and let's say, for example, now he's deriving an income of, say, 8,000. Okay. Now, is that 8,000 going to be subject to tax for that non-resident shipping operator? There are two questions you have to ask. Okay. So, Mr. South African shipping operator, for the past 24 months, have you ever come to Malaysia? Right? Have you ever come for you, this ship or any other ship, your company ships and airlines, has it ever come to Malaysia? Answer, no, sir. We don't cover Malaysia. We don't cover Singapore. We only cover the Australia, right? Australia and New Zealand. Very good. Last question for you, right? In the next 24 months, right? In the next 24 months, are you expected to come to Malaysia? The answer is no. Therefore, casual calls is not subject to tax. Any sense? Got the concept? Okay. Now, ladies and gents, let us see. Okay, let us see. Time is just going like crazy. Okay, let's say, for example, you got this Nippon, right? So Nippon, so the tax rate SI is deemed at 5% and the tax rate is 24%. So please take your highlighter and highlight this. Okay, because there are too many figures here. So I want you to take a highlighter and highlight this. So whenever there's any green highlight, means current. Old, if there's no highlight or a red highlight, means don't bother. That's wrong. Okay. So make sure you have a system of actually highlighting what is relevant. Okay. Now let's say, for example, Nippon has got a gross revenue of 20 million, determined under the 5% method. 5% method says 5% of DSI is 5, deemed statutory income is 5. So 10% of 20 million is 2 million, but half of it is 1 million. Okay. But ladies and gents, don't reduce any cap allowances here because it is already deemed as statutory income. So that's the mistake you must make sure you don't do. Okay. Make sure you don't do that mistake. Okay. Now, let's say, for example, there is this ratio certificate method. Okay. Then you take a proportion. Okay. But let's look at this example. N line from Norway, the total freights from Malaysia, right, is 5 million. Okay. So under the 5% method, ladies and gents, what is the deemed statutory income and chargeable income, ladies and gents, right? So under the 5% method, I'm going to take 5% of 5 million. 5% is quite complicated. So you take 10 million, 10%. 10% of 5 million is 500,000. So 5% will be 250,000. Okay. So the deemed statutory income and chargeable income is 240,000. But under the ratio certificate, what it is, the Norwegian tax authorities will issue the gross revenue, the gross world revenue, right? Gross world revenue, and the Malaysian revenue, of course, we already know, 5 mil. And the world adjusted income and world cap allowances, what you take is you take a proportion. So you take the adjusted income of 25 million times 5 million divided by the world adjusted income and take a proportion, right? And then you minus the proportion of the cap allowances and arrive at your statutory income, and therefore the tax rate will be 24%. Okay. But let's say, for example, now they tell you there's this marine, right, in Singapore, operates ships between Malaysia and Singapore, and freight outwards from Malaysia is 25 million, right? Now tell me, what is the deemed statutory income under the 5% method, ladies and gents? Under the 5% method, it is how much, right? So you take 10% is 2.5, so half of it will be 1.25. Okay. Now under the ratio certificate method, you take a proportion, but here, ladies and gents, you have a transshipment of 1 million. So transshipment and casual calls, if casual calls is exempted, then you must minus. So in this case, from the Malaysian 25, you must minus 1. So it will be 24 divided by the world times the world adjusted income, and then your statutory income. But here in this case, ladies and gents, you will be revising your tax computation because your ratio certificate method is lower. Your tax under this method is lower. So you can actually submit an application within 5 years. Okay, ladies and gents? Within 5 years. Within 3 years, sorry. Within 3 years. Okay. So under the 5% method from transshipment, right, it cannot be deducted. Okay. Now, I actually wanted to do an exam question. Okay. Now, ladies and gents, you see, let's say, for example, there's this M from Philippines, right? Yeah. So now what is the 5% method? How much is the 5% method? What is the deemed statutory income from 5% method, ladies and gents? Under the 5% method, how much is it? Without lifting your calculators, okay? How much is the SR, deemed statutory income under the 5% method, ladies and gents?
8 million.
Sorry?
8 million.
Okay, anybody else?
5 million.
Anybody else?
20 million.
Sorry?
20 million.
No. What is the deemed statutory income under the 5% method?
2 million.
5 million.
How do you get 2 million? How do you get 2?
1 million? 5% of 20?
Sorry, you said something just now. You said 1 million. The reason why you said 1 million is because the income from Malaysia is 20 million.
20.
You cannot reduce any transshipment under the 5% method.
Yeah.
Now, under the 5% quite complicating. So what you do is you take 10% first. 10 times 2 is 2 million, but half of it is 1 million. So that
1 million.
Is 1 million. Okay, but for the other method, you can only take
20.
You take a proportion. Now you cannot take 20. You must take 18.
20 minus 2.
Very good. So 18 divided by the world is 160 times 40 and times 10. Arrive at your DSI. Okay. Ladies and gents?
4.5.
Yeah. So it's not 4.5. It's not 4.5. But anyway. So the thing is, ladies and gents, I have to now seek your forgiveness because I have to move to the next topic. The next topic is actually quite complicated. It needs a little bit of time, and I'm not sure, Dr. Salwa. Now, what happens if you're not able to finish it today?
Can always carry forward to next class.
It's okay. We can continue on Monday. If we still don't have enough time, we can do extra class. No problem.
Yeah. Okay. Oh, that's great. Okay, that's great. Okay, then in that case, let's finish out this question. Okay, so now I'm going to give you some time to finish this question. And I want you to tell me what is the CI, chargeable income for the ratio certificate method. The ratio method is called.
$4.5 minus world capital allowance is 10.
In the exams, you've got to be careful because 4 marks. So you got really maximum 8 minutes. So it's about 6 minutes in the exams. Okay. So, ladies and gentlemen, in this MICP exams, time is a big problem again. Okay, so you got to manage it well. Okay, so how much? It's basically calculations, right? It's really nothing but calculation. You take 18, right, divided by 160 times 40, right? Okay, so here under the ratio certificate, first you must do the 5% method. You have to submit a tax return based on 5% method, 5%. Then only you can do the ratio certificate because the certificate has to be issued to the tax authorities. You have to do a lot of audits, right? So they give you 3 years time to do it, okay? So here in this case, you take minus transshipments. So 18 mil minus 160 divided by 60 times 40. So you get a proportion of 4.5 and your cat allowances proportion is 1.12. So your SI is 3.0. Now, but what you must not do is you shouldn't take the CA and minus here. That is wrong because this is already a deemed statutory. Yeah, so you cannot Yeah, you just follow the rules. Okay. So in this case, you won't be revising the tax com because quite clearly you have much better off under the ratio certificate method. Clear, gents?
Okay.
Wonderful, wonderful. Okay.
But I just that you have that capital allowance.
Yes, please.
I thought that just now I saw world capital allowance, so you don't have the Malaysian capital allowance, world capital allowance, and the
No, no,
company.
no. You see, let's say you are the shipping operator, right? Let's say you're from Canada, right?
Okay.
You're operating Canada. Now your assets are actually there. You're conducting business over there, so you will have your computers in your table, your furniture, and all that is there. See, you see here. What you do is you come in here. Right, there's an office, so you rent a space, right, for any, say, quick queries and do yours, right? So in this case, of course, your business is carried out there, so you don't really have, so your cap launches that you're calculating will be assessed in Canada, will be included inside here.
No.
You know what I mean? So don't worry, you are claiming the cap launches that you're using in Malaysia, but it's already Damascus, right? So it's already included inside here. So it's already included inside here. So you're taking a proportion of the world CAs for your, which, to be fair, ladies and gents, to be fair, you have to take the proportion of the world CA and minus it.
Based on your income over gross world income times by the capital allowance.
Yeah, you take your proportion. You take your proportion.
Okay.
The Malaysian government doesn't want anything extra from you. Okay, they don't want anything extra from you. Okay, they're trying to help you. Okay.
No, so but that's my question. I thought that there would be one term known as world capital allowance. World capital allowance, but world capital allowance dia tak ada gross world income. Okay.
Yeah. So you wanted to calculate. You wanted to take a proportion of world CA. They give you the world CA. You take a proportion. End of story. Right. Okay.
All right.
So now, before I leave you, ladies and gents. Okay. Before I leave you, I want to just introduce you to insurance. We won't be finishing it today. I won't be finishing today, but I want you to be insurance experts. Okay?
Sir, sorry, can I ask a question?
Please.
About the passive question, the marker that we did just now. Can I confirm that you said to choose the higher amount, which is using the ratio certificate method?
Yeah, you see, now what you do is when you are now submitting your tax returns, you will apply the 5% methods because you cannot have the other information yet. Okay? So in this case, under the 5% method, your chargeable income is lower, but we don't know whether it'll be higher or lower, so you have to compute based on the certificate method. You don't know. You see, how do you know whether your ratio certificate is lower than 1 million or higher than 1 million? Unless you actually could do the calculation kind. So in this case, when I did the calculation here, I won't be opting for the ratio certificate. I won't because it is higher taxes. I won't.
So it's up to us to choose the lower chargeable income based on
but you have to submit based on the 5% method first. You have no choice. You have to do this first, okay?
Right.
But here you have a choice. Okay? Because like we discussed earlier, which is 39 is you see here they're saying that the ratio certificate method is saying that you have to submit it it's within 3 years.
Yeah, within 3 years.
Yeah, it is within 3 years.
Yeah.
That is para 3.10. Yeah, this option is given to those who are residents who are acceptable. Within 3 years, see? So you look at 311, when assessment has been raised under 5, a revised assessment may be made if acceptable ratios is submitted within 3 years after the end of the relevant year of assessment. Okay? So the Malaysian government does not want anything extra from you. Okay, next. before I leave you, we'll finish up the class at about 9:55. Okay. And ladies and gents, right? Let me just quickly go off to insurance. We'll just do life first, and then we'll leave the general first. Okay. Now, life insurance is also it's it's a financial industries, right? It's part of the financial institutions, just like a bank, right? They actually receive a lot of. They're sitting on their cash, right? I mean, the inventory stocks is cash, cold hard cash, right? So it's massive, and it's highly regulated, right? It's highly. So the insurance industry and the banking industry and the Islamic finance industry is highly regulated. Highly regulated. It's one of the most regulated industries, right? Okay, so for the life insurance, ladies and gents, right? For the insurance company, sorry, we have two main types of businesses. Okay, so one of the requirements is if you have two types of different businesses, you have to assess it separately. You cannot combine. Okay, so if you have a life insurance business and you have a general insurance, you have to combine. You have to separate. You cannot combine. So you show it separately. So your gross income from general is different from life. Now, one point, ladies and gents, before I let you go, is let's say, for example, now you're going to go and you become an insurance agent, right? You become an insurance agent for, say, MAA, and you go and call your cousin and you say, look, why didn't you buy a policy from me? And you issue a policy for 50,000 and he pays you a premium of 3,800 every year. He has to pay until the term is under the terms of the insurance. Now, that gross premiums from issuing policies received under life, ladies and gents, is not subject to income tax. Okay, so the life insurance industry is very unique. All you have to do is you don't do a normal PBT, right? It's much easier if you take the gross income subject to tax and less the deductible expenses. Whatever is taxable, put inside. Whatever is not taxable, you put nil, right? Whatever expenses is deductible, you claim. Whatever is not deductible, don't bother, don't touch, because otherwise we'll charge you penalties under self-assessment, right? So one of the unique features, ladies and gents, under the life fund is it is not subject to tax. Okay, now here, what we'll do is when we come back, right? Now, when you read these notes, it's actually in order to read this, it's just full of words. It's one of those topics where the words is so a lot, right? And we accountants, right? So I've actually simplified it. Now what I want to finish up with today is, ladies and gents, now, all right, so we're going to stop with insurance now. We have only finished, we just not even started properly. So when we come back to start, we'll go on to insurance. Then banking is very fast. Banking we can finish up in a very relatively short period of time. And then we can go on to the next topics, which is schedule, right? So we got your 9, leasing, and 10, right? So Dr. Salwa will actually identify these topics. But I want to leave you with one message before you go for your next class, okay? Now, ladies and gents, when it comes to tax, you can even check with Dr. Salwa and you can check with Dr. Khatija if you don't believe me, right? If you want to check with them. Tax is something you cannot escape. It's one of the few, there are a couple of things. So ladies and gentlemen, now let's say, for example, you're finishing a class today, right? Today at 5 o'clock. And your auntie's outside. Hey, I didn't see you so long. Where were you? Yala, I had class. What class you went for? I went for I had a tax class. You're so much of things to remember. Come, sit down. I want to ask you a few questions. I just sold my property. I want to ask you a few questions. Ladies and gents, you can't escape, right? It is going to benefit you, right? It is going to, of course, you're not going to work in an insurance company, but you're having a basic understanding to go, right? Examiner saying having a basic. Ladies and gents, I don't want to take too much of your time, and I'd like to sincerely thank all of you. And if there's any questions, we can take it on for the next classes. And I would like to thank Dr. Salwa and Dr. Khatija for giving this chance. And if there's nothing else, I don't want to delay you any further because I've already delayed you more than 6 minutes. Okay? If there's nothing else, then please take care and see you soon. Okay?
Thank you, Mr. Ravi.
Thank
Okay,
you.
thank you very much, Mr. Ravi. Those who have class, you can leave now. Those who don't have class, if you want to stay and ask questions, you can spare some time for us. Right, Mr. Ravi? Because I have a question to ask to you. Those who have class, they can leave now, eh? Mr. Ravi, are you still here? Mr. Ravi, where is
Left already.
Left already. Alah, I want to ask a question.
Memang you can ask it now. You can ask question now. We'll try to help you.
Okay lah, can ask in WhatsApp. Aja dia keluar. Okay lah, so I'll see you.
Thank you, madam.
On Monday. InsyaAllah. Thank you. Assalamualaikum.
Assalamualaikum.
Thank you, madam. Thank you, madam.